Combating global climate change over the next 20 years needs a unique investment viewpoint. At Schroders, we capture the most advanced environment-driven companies who are shaping a low-emission economy. For example, clean energy from solar and wind technologies has already become the most cost-efficient form of power in many parts of the world. New homes are being built from sustainable, energy-efficient materials, and demand and response power technologies are fast becoming a reality. More affordable, reliable electric vehicles have meant advancements in public transport and goods delivery, all leading to cleaner and congestion-free cities. New world companies are fast developing concepts such as plant-based foods, precision farming technology, and reverse vending recycling schemes. Industry is adopting processes to eliminate carbon emissions, and consumers are embracing products and services with strong environmental credentials. The technologies are already here. They'll continue to reshape our environment to combat climate change. And with change comes opportunity. Start your climate change investment journey with Schroders today.
So our next session is called Beyond Profit, Sustainable Investing, A Force for Good Returns. It has a Star Wars connotation, it sounds to me, a force for good returns, but we can explore that a little bit. I'm very pleased to introduce our next speaker, Lazario Tiant, and he goes by Laz. So we just heard about real estate and the concerns around climate risk, and what we're going to discuss next is your investments, right? Individuals, their two biggest, you could say, assets are the homes they own and potentially their 401k and or their investment portfolios. So on the investment portfolios, ESG has been the magic buzzword over the last few years. It's been a real rapid growth in the ESG market. I think last year Morningstar estimated there was $51 billion in new money that went into ESG investments, compared with $21 billion the year before. And this has been a real growth trajectory over the last 5 years. So Laz, I'd like to start and have you, you've only been with Schroders for a short time. What excites you about the ESG space, Schroders, and its approach to ESG?
Sure, yeah, that's a good question. I think coming from the research and rating service provider space, I was able to cast a wide net in seeing what was happening, right? From the large global institutional players like a Schroders, but then also maybe the smaller firms that are just taking on their early efforts in their ESG journey. And so what's been exciting for me is seeing that transition actually hasn't been that difficult, in seeing how Schroders is going about the investment process. And it's almost as if we've hit this landscape where it's not just about having an investable product, but a full solution. I think what people are looking for now, our clients, our partners, are focusing on help us understand what our opportunities are, what our ambitions should be. So there's an educational element that I brought from my time at Sustainalytics over to Schroders. There's this element of having the right tools, research, and support that allow you to really grab a full perspective of those risks and opportunities. Taking it even a step further, being able to, at the end of the day, have that investable product is what I was missing in my previous experience, right? And so being part of that overall process now at a firm that has really taken this to heart over decades, right? And seeing that there's already a sound infrastructure, a commonly understood language across all asset classes, as well as a willingness and a fully bought-in culture that is taking this to heart in their day-to-day decision-making.
So maybe it's just starting at a high level. So I mentioned the Star Wars reference, and so now I'm picturing you as like a Jedi Knight in training on ESG. Please Jedi don't. Knight. But there's been a tension, particularly over the last, say, decade or so, between active management of investments and passive management of investments, right? Is ESG potentially the new hope for the active management?
I think so. And simply because there's much more of an appetite and interest in seeking out active opportunities versus just passive, right? Or complementing those previously chosen passive opportunities for active opportunities. And more so because there's an opportunity to do things through an active lens that you just can't in a passive. And increasingly seeing the different opportunities that are arising because of climate or social equity, you need to have that overall nimbleness to be able to react and anticipate certain opportunities to be part of. And so, taking a step back and thinking about this from the perspective of climate change, global climate change, there's a radical movement and transformation happening right now where you're seeing this needed to be tackled and invested in so many different areas, so many different directions. And thinking about what that means for companies and their financials, right? There are so many opportunities whereby now they can either, directly or indirectly have exposures to some of these different nuances to climate change. And that could be seen in the demand for their products and services or the costs that are associated with regulation. But the other side of that is thinking about their assets, right? What kind of asset impairments do they have to be concerned about? What are contingent liabilities that can affect the balance sheet? And being an active manager, you're able to really consider those different elements to the investment process and allows you to, again, act and be nimble.
So yeah, so the nimbleness is really the key there. And just as a kind of side note, a lot of ESG information, unfortunately, and it's improving dramatically year in by year out, but a lot of ESG information historically has been, a year and a half old before it gets actually published in a sustainability report or so. And so, if you think about that, if you're going to be making investment decisions off of, older information, you would want an active manager, arguably, that would be there and analyzing the data on a day in and day out basis to get that nimbleness that's so crucial. Just one other question kind of on the ESG. So much money's been flowing in, right? And do we run the risk of, say, business as usual interests kind of pushing back, say the empire in the sense, pushing back on the disclosure of ESG information if returns aren't, where we hope they will be with ESG?
Mm-hmm. I appreciate the Star Wars references. I would hope not. I hope that we're beyond this space thinking that ESG is a different way of doing things or sustainable investing is a different way of doing things. I just spoke about different areas of generating alpha, right, through understanding the different climate opportunities that are arising. And so hopefully people or traditional managers see that as part of what they should be doing anyway in their day-to-day, whether we call it sustainable investing or ESG in 10 years. I don't really care. I want to put my head down and seek out these opportunities properly. Have the right tools and research and resources and bought-in culture that is trying to, follow along that same pathway. So while I think there's always going to be individuals or just general maybe groups that dismiss what is being looked after as relates to ESG, there's clear evidence that these topics need to be really understood to be able to make the right kind of impact as well as make the right investment decisions as part of the fiduciary responsibility. I think beyond that, we're just having the same conversation over and over again about the good ESG can do.
So let's talk a little bit about the tools that you use. What is it that Schroders uses to assess and quantify ESG?
Sure, there's quite a lot that we have at our disposal. And so what we have is this overarching framework called ImpactIQ. And in layman's terms, I think about that as, do we know everything that can be potentially an outcome, right? So what are these broad impacts that we just simply need to know across a portfolio, both positively and negatively, right? So the way we think about that is we have this ABC framework, the A being act to avoid harm, B to benefit stakeholders, and C to contribute to solutions. So if you think about those first two I mentioned, act to avoid harm, benefit stakeholders, we have this tool called SustainX. Right, and SustainX is really intended to think about all these positive and negative externalities companies can be facing, right? And really, in hard dollars, in a monetary lens, quantify what those impacts might be, positive or negative, or if these ESG trends are to materialize or crystallize over time, right? So it's taking that lens such that if you think of traditional ESG factors, whether they fall in the spectrum of social responsible screening or deep ESG integration, there's a forward-looking nuance that can be captured through this analysis, right? And understanding that there are societal and economic implications for the kind of products you sell, the kind of production and manufacturing that you have as part of your operations. And so we're quantifying that through that lens. What's complementary to that and also falls within that bucket I was referring to is something called carbon VAR, carbon value at risk, which is a model which allows us to simply understand if there's carbon taxes imposed on companies or industries, what does that look like in terms of affecting their sales, cash flows, overall EBITDA. So in being able to have that perspective as part of the early stages of the investment process to allow us to define an investable universe for, maybe a climate change strategy, it's putting us in a well-advantaged spot in terms of being past integration, right? I think a lot of firms are focusing a lot on where they are in their integration journey. Right now, we have that through this toolkit, right, to then be able to put together sound strategies. Another element that falls under that ImpactIQ framework, the C, contribute to solutions, will be more so of what we're doing in terms of alignment, right? So there's sustainable development goal alignment, there's overall climate alignment, and so that plays an important role in our process for two reasons. One, idea generation, defining that investable universe if you're trying to, at the onset, have that kind of alignment. But three, be able to report back to clients, right? I said earlier that, one of the things I'm excited about at Schroders is being in this ecosystem of holistic solutions. And a lot of those solutions are so consistent in that we're able to leverage the same information that we're doing on the onset of the research process, and that same information and through our lens, models that we control and can tweak in our time frame is also the same element of what is being reported back to our clients, both on the institutional level as well as wealth and retail.
So I think that's an important element. It sounds like there's a real active engagement level with the clients, right? Outside of just voting proxies and stuff, you're actually meeting with clients and telling them about expectations, or I don't know, maybe even identifying opportunities.
It's driving the conversation, right? And that's where I think my previous experience was a good fit for where I'm at now, in that, it first starts with ambition. What are you trying to get at from a sustainable investment perspective, right? And then what are those asset classes that you're trying to focus on? Because there is a spectrum there. And so to be able to engage by asking the right questions, right? Understand what the person's ambition is, be able to have a sound assessment, leveraging the tools that we have. It's not just for us to take into account for our own investment processes or report back to our clients, but to look at our clients' existing portfolio, right, and really understand where there could be risks or opportunities they're not currently thinking about. And that needs to play a part in our engagements with the space, right, to be able to just better serve at the end of the day as a manager. And also plays a role in how we engage with the companies we're investing in, because we're highlighting these certain risks and vulnerabilities and sensitivities to some of these issues and juxtaposing that with what they are or are not doing to be preparing for it, right? And so one other tool that kind of falls beyond the ImpactIQ framework is called context. And so context is available really at the mercy of our research analysts to input sound information. There's, from our sustainable investment team, which I sit on, a lot of effort and resources put to have these tools available and underlying data and context, for lack of better words, included in that kind of robust framework. However, it's the analyst, the portfolio teams that are sharing information that allow them to just have more informed perspectives of those companies and industries and what they're facing, but also how they're just running their businesses. Right. And having kind of this global footprint, we're able to share that analyst knowledge in a dynamic fashion through that.
It's just great to see such a maturation, you could say, of, from, you could say, old school social responsible investing, back 10, 15 years ago, which was just to avoid certain industries, right? Just pull the money out and then put it into other areas. And this is a much more robust engagement process that hopefully and kind of lifts up the industries that are potentially lagging, because they're starting to hear from key investors like Schroders as to why they need to embrace environmental, social, and governance issues.
There's one other tool that I didn't mention just for the fixed income folks in the room. So we have, for the municipal side, is a Municipal US Sustainability Explorer we call Muse. We have a dashboard that's publicly facing on our website and play around with it, but it's essentially really understanding at both the state and county levels what some of these ESG related impacts are, right? And we are able to complement that with sovereign SustainX, which is similar to the corporate SustainX I just referred to, and really quantifying these externalities should they fully crystallize. So those two components put together.
So you can rate municipal bonds in essence from that?
Gives us a perspective
well, not rate, but you can
of the
evaluate.
municipalities, right? And the exposures and risks from the ESG standpoint, but then also forward-looking again, where are the opportunities that we're seeing today in sound education within a municipality, right? And what that can lead into in terms of monetary or societal impact.
Maybe let's switch and talk a little bit about the data itself that is underlying all this. Where are there gaps currently that you're seeing in ESG data? And maybe if you had a wish list, what would you like to see?
I think carbon emissions data can get better still. I think while it's been a dominant data point to understand carbon exposures, there's still a lag, particularly as it relates to Scope 3 emissions. And so, we have wonderful models that take into account hopefully what companies themselves are disclosing, but the better that data gets and the more there is insights into Scope 3 emissions, as I mentioned, the better these models are going to be. So I think that's one that's really important because it's consistent across the market, I think, in terms of being a data point that everyone's looking at and appreciates as a lens into exposure. So I think we all benefit from that getting better. I think a lot of people focus on diversity, equity, inclusion right now, and that's a tough one for obvious reasons. I'm not so much focusing on, take racial diversity within the workforce, for example. I'm not so focused on, in the past year, the number of people you have brought on as employees. I'm more focused on 2, 3, 5 years out from now, what is retention like? What was training like? How have wages changed? What does that employee's development look like? And what is that feedback like, right? Their overall sentiment of working at a certain organization. So while I think a lot of people are really focusing on engagement now and helping their firms think about adding to the pool of diverse talent, I think it's going to be more so important to have that right policy, program, infrastructure, and systems in place to really take advantage of what you're doing today,
right,
diversifying your workforce. Now, on the senior management and board side of things, there is good data on understanding gender diversity. Racial diversity is going to get better. I think that's the lower hanging fruit if you want that kind of data, right? It's going to be at the executive level. So that's going to continuously be something that's important as well, because diversity of thought right now, as we're taking on all these different issues, it's a very important aspect.
Yeah, I remember years ago seeing Sally Krawcheck speak from Citigroup. She was considered the most powerful woman on Wall Street back when the financial crisis hit in 2008. She was on the board of Citigroup. Long story short, she said that had there been a diversity of thought on the board of Citigroup, they might have had some second thoughts around these synthetic derivatives and all these other things that were coming out around the mortgages, because in essence, they all grew up in the bank and they were all kind of afraid to ask a question as to, well, we don't really understand this, because they thought they would look bad with their peers. And she said, what I would have given for just some college professor or someone to be on there and say, I've never heard of this, explain what this is, because she said that in essence they all assumed somebody else knew. And I think that happens a lot on, my concern on issues like climate is, the governance of it on the board level. Does the board even understand what's being reported up to them, and and how they look at that? So
right, the diversity needs to be in background too. If you're trying
right,
to tackle climate change, you better have some climate scientists readily
you
available to at least be able to speak the language that you need to be given this message to.
Right. So on the there's a proliferation of disclosure frameworks. what are the ones that Schroders advocates or finds most useful in the?
I think that if you look at TCFD or SASB, I think those are great frameworks because it's allowing for consistency and education. I think a lot of the gripe that ESG or people had on ESG sustainable investing going back the past few years was that overall inconsistency and not knowing what issues to focus on, not knowing what the concept of engagement really means. And these frameworks are really laying out somewhat of a cadence for that ESG journey and knowing what you need to be focused on within your current book of business. And if you're saying that you want to be impactful, what does that mean as well in terms of recognizing the opportunities of climate change, for example? And so I think as we think about regulation happening right now and what's gone on in Europe and what can happen here in the US, it's just preparing everybody for that, right? I would hope that these government bodies, these policymakers are referencing and leveraging all of this good work by industry bodies such as SASB and taking that into account in whatever rules.
And not reinventing the wheel.
At least to, you don't have to take things word for word verbatim. I think what SASB is doing is providing a great taxonomy for people to align to, right? Especially when it comes to defining what materiality is and what issues are material. And finding that common thread of language, but it's really most useful for the regulators to educate themselves as well. And hopefully provide a lens that allows managers that might not be as resource intensive as the Schroders to have a framework that they've built thus far to prepare for what could be coming in regulation.
So how do you view the net zero commitments that companies are making? Is that risen to a level, say, a materiality yet, where you feel that these commitments are robust enough that they potentially change the trajectory of the company's exposure on issues?
Yeah, I mean, well, first off, I'm all for companies putting additional pressure on themselves, right? I think that's a good first step in acknowledging that these are real issues and risks that play a big role in their financial performance going forward, but then also the externalities that have nothing to do with their business and just society generally. I think that thinking of Schroders, for example, and the investment management industry, because it is industry by industry different, right, and how I view your net zero commitment.
Sure.
And thinking about the industry that I work in, it's all about scope 3 emissions. I think Schroders has announced that we're committed to going net zero, and we have a plan that's forthcoming. And so at the corporate level, I'm sure there's going to be a lot of initiatives to address scope 1 and scope 2 emissions through our current workforce, our tangible assets, offices, really, that's about it. And making sure that things are running on renewable and that travel and such, remains at bay. But when we think broadly about scope 3, it's our investment dollars, right? So we're in this position.
Which probably dwarfs any of your own footprint from operational side.
Exactly. So, you're able to kill a bunch of birds with one stone and being able to respond to all this pent-up client demand and building sound strategies as it relates to climate change, and all the while going towards that journey for net zero commitment internally. So for us, generally, it's making sure that translates throughout our investment processes and philosophies. But again, sector by sector, very different answer.
Yeah, just for the audience's edification, in case you don't know, is the scope 3 emissions discussion in the financial sector is around what you lend to, what you invest in, what you, in fact, now, and also what you insure. There was an announcement last week where they're now going to look at insured emissions as potentially part of a scope 3 contribution of insurance companies, which is groundbreaking. I'm wondering, so with the ESG data, and at least historically, it's always looked at what risks you potentially have, right, in environmental, social, and governance issues. How are you looking at opportunities? And particularly around climate, but also, say, social equity and other areas. And how do you get clients or make sure that clients are incorporating that in the type of information they disclose?
That's a good question. So, if you look back to 2007, we launched our global climate change strategy, right? And we were really focusing on who's to benefit from all of this, right? And understanding that there are players that are producing and manufacturing products and services that help us go to a low carbon economy, but there's also what we consider to be, low carbon leaders, people that you might consider to be household names that maybe you have a head scratching moment when you see it in a particular fund strategy, and that's to say that we're redefining best in class based on how companies are getting ready to prepare themselves for moving to a low carbon economy. If you think about technology and consumer companies, those have moved from physical data centers to computational cloud infrastructures are well advantaged to take on a carbon tax if it is imposed, right? So that's one element of how we're thinking about opportunities. It's not so much just what are you producing and how are those revenues attributed to something benefiting society or the environment, but how is your business overall impacted from this ever-growing climate change concept, and how advantaged are you versus your peers from an earnings perspective, right? Because if carbon becomes something that's on the balance sheet, there are companies that are well advantaged in being best in class and have better relative earnings in that instance. But on the other side of the coin is that we are targeting certain themes, if you will, across energy efficiency, clean energy generally. And if you think about this overall value chain and how we're thinking about our energy transition strategy, it's looking at not only the production, but also looking at the distribution as well as the consumption of energy, right? So that's very targeted and going after the companies that are actually bringing us to what we consider to be a low carbon economy. In the private markets, we have a bit more creativity at our hands, right? And being able to look into, as being an emerging markets and international specialist, and having underneath the Schroders umbrella part of the organization such as Blue Orchard, right? And being able to look at frontier markets, emerging markets, and think about things such as microfinancing as well as sustainable infrastructure.
I was wondering if you could tell us a little bit about, Schroders owns Blue Markets, right? Blue Orchard, I should say, right now. Could you talk a little bit about some of the leading work that Blue Orchard is doing? It's a fascinating company. Yeah,
absolutely. Those who don't know about Blue Orchard, I'd consider them to be a pioneer in what people call today impact investing, right? Particularly in the private equity and private credit space today. And
they've been doing it for about 20 years, which is longer than anyone.
Yeah, and I obviously wasn't here when they became fully part of the Schroders umbrella, but to me it seems like a perfect match in terms of philosophy and, let's say, a readiness to act on a lot of this opportunity. And so what Blue Orchard is doing is being creative globally and being able to tackle those opportunities. And so in the public equity markets and fixed income markets, I think people are struggling with how do we think of social issues and build strategies around that. I think people have come to grips with how do we factor that in terms of risk and future opportunity, but today, where's that opportunity? And so I think that side of our business is really able to exploit those opportunities because there's major investments needed in infrastructure to be made available for the change to actually happen, right? And so through that private market, we're able to make those investment opportunities available in those frontier and emerging markets, which has been a great thing for investors in Europe as well as in the US, where they continue to gain a lot of traction. And now here in the US, we're focusing a lot more on jobs, right? In terms of being able to put private capital towards social issues. And so you'll see and hear more on those kind of initiatives in the future with us.
That's great. So as a full disclosure, I work with Schroders on a project right now with the Intentional Endowments Network, where we're looking at a market that's been forgotten in a sense as far as the incorporation of ESG, which is retirement plans. So we look at with the IEN, it's about looking at the 403B plans of universities, and the fact that the retirement plans are much larger than the endowments, about $1 trillion, and yet the average university has basically no lens of ESG on their investments. Huge opportunity. I'm wondering, where do you see other opportunities? Where is there inertia in the market or reluctance in the sense to embrace ESG?
I would say, and this is really where I'm focused on in my remit at Schroders, it's the wealth and retail channel. I think there's a lot of institutional knowledge that understands what they're looking for, and I'm talking about the big plans out there that we work with, right? They have an understanding of these risks and opportunities, and they're looking for the right partners to help bring them from A to Z, right? And that's a collaborative conversation where we're able to put that ambition, assessment, action framework into practice pretty seamlessly. The wealth and retail channel is a little different in that speaking about Schroders specifically, we have such a wealth of information and knowledge that is here in the US as well as in Europe. How do we rethink about that knowledge, not only from one region to another, but from one market segment to another? And that's to say, there's a lot of education that needs to continue to happen with the wealth and retail channels and family offices as well, to be able to understand what those ambitions are, to have the right kind of assessments, and to be able to act accordingly. And so through our partners and through our own means, we're trying to make our product suite available such that there is plentiful option. However, if a financial advisor is not able to articulate, here are your options, and some have different benefits, then maybe someone goes to passive because it's a one-size-fits-all.
Right.
But when you have active strategies that are meaningfully trying to address some of these issues that might be near and dear to the heart of that person at the end of the table, there needs to be a level of education and messaging available to do that in the right way. And
Yeah, opportunities for alignment of values in essence. Yeah.
That's what it's all about, right? And so we're not there yet. The market isn't there yet, but I think that's where there's increasingly pent-up demand, particularly as there's just a transition of dollars going from one generation to the next.
So we're getting near the end of our time. I'm wondering if there's any questions for Laz. It's hard to see you guys because the lights are very bright. Oh, yeah, okay.
The argument for ESG is a long-term investment priority, makes sense, it's natural, it's criteria. Just curious, as the world is so dynamic with labor issues, pandemic, severe weather events, have you applied the tools for short-term investment decisions? Are there very specific examples you can share with us? How do you apply it to near-term decisions?
Have we applied it to corporate?
To short-term decision-making.
In
Yeah,
terms
you
of
could see corporates, I would say.
Yeah, in terms of short-term decision-making, all of that, you can't necessarily act without knowing where you are, right? And so all these tools at the very forefront are letting us know where we are in our current suite of, I guess, investable product. But as we create new, it's helping us define the universe. And so you got to always play that balance of where are the exposures to some of these risks that you just mentioned, but also who are these companies that make our universe that are best positioned to take that on, and not only take it on, but hopefully thrive and create new business opportunities. So it's very much so part of the end-to-end process for us, including how we communicate to the market and our clients on that kind of performance.
Any other questions? If not, I thank you, Laz.
All right. Much
Great
appreciated.
discussion. Thank you.
Likewise. Thank you.